This is a real life live example of me responding to a client in their question in my inbox on a policy that I got set up for him a couple of years ago, and him questioning, is an IUL or whole life better for him in his situation? Hey John, this is an absolutely incredible question and I want to go ahead and answer it for you. And so let me just repeat the question. I have your email right here in front of me. And so can one of you, referring to Caleb or I, explain why a whole life policy was better for my situation than an IUL, both for my policy and my kids? A colleague of mine was explaining that an IUL would have been more beneficial. See this email here below. Okay, so this is, and once again, an incredible question and something that we get often in regards to when people come to us, is why one better than the other. And if you go search the internet, which I'm actually going to show you some examples, there's lots of people out there that are fighting for one side or the other. What we've tried to do here at Better Wealth is we've tried to be very agnostic, and we've tried to say, okay, all products have a specific, unique place in the marketplace and could be a great tool if utilized properly. But with that being said, there's some inherent risks with both, with whole life and IUL. There's a lot less risks with whole life. It's a lot more conservative, and there's a lot more risks with a little bit more upside potentially in an IUL. And so for me, just giving you my basis of why one is better than the other, specifically in your case, you are an entrepreneur that is in real estate, that is doing incredibly well for yourself. When I start to think about whole life versus IUL and which one's better, we want to position that whole life is more of a foundational asset that has guarantees, that doesn't have any downside, that still is going to continue to grow no matter what happens, has a guaranteed death benefit, and is not prone to lapsing as long as we continue to pay our premium. When we look at an IUL, what an IUL does is it combines the concept of upside potential, looking at an index, usually the S&P 500, but there's other indexes as well, combined with the insurance piece of it. By combining the investment side and the insurance side together, there creates some more inherent risks. And so as a whole, there's an option strategy on the back end when it comes to index universal life. And then in the whole life, there's a lot more guarantees. The risk is on the insurance company in that situation, and the risk is more on the insured when it comes to the IUL. And so I'm not necessarily coming here and telling you that one is better than the other, but for your specific situation, being an entrepreneur, wanting control, safety, liquidity, and wanting the ability to borrow against use for asset producing activities, you want your money to be there and to continue to grow into the future when you have opportunities that present itself. And so for me, I feel 100 times better putting you into a whole life insurance contract than an IUL, because an IUL has so many different levers that are moving, and you have no idea what could happen at the end of the day. And so we have somewhat of an idea by looking at illustrations, using the right company, designing it properly, but there's still some inherent risk there. And so we'll kind of go through these questions one by one. And you said, well, this is exactly what your friend said, your colleague. He said, I elected for an index universal life. I am satisfied with my decision from what I understand. I preferred it over whole life for the reasons below. So one, when he said from his understanding, again, he's not an insurance agent. And so I just wanted to put the elephant in the room, is that it sounds like he's very educated from what he shared, but there are some disclaimers that are not being fully shared in regards to what he's saying. And so first and foremost, there's more immediate cash value. I would say that this is, again, a caveat and a disclaimer that I have looked at hundreds and hundreds and hundreds, if not thousands, of illustrations, and I've compared whole life to IUL, and 98% of the time, a whole life contract, when both of them are designed properly, so this is important, they both have to be designed a specific way by an expert. When designed properly, the whole life contract does have more cash value early on than an IUL. Now, there are some companies that are starting to get a little bit more creative that I have also seen for that 2% of the other companies, where they are having some more upfront cash value than a typical IUL. But what it does is also sacrifices some of the long-term growth. And so with that being said, an IUL is really good for retirement planning for a lot of the instances. And so what ends up happening is the IUL is meant for long-term growth, to have more of an upside, having time on your side. And when they're sacrificing some of that long term and putting it up front, the whole purpose of the IUL essentially is diminishing from that perspective. And so when it also says significantly lower front load costs, that adds up to the first bullet, low to no upfront commissions. Again, I'm not 100% an IUL expert. And what I mean by that is I do not know every single company in the entire space that has IULs from start to finish. And these companies are starting to get more and more competitive, and they're starting to crack down, and the laws are starting to come into place, and they're starting to get better. And so what these companies are starting to do is trying to be more creative to gain more of the market share, because what they have done over such a long period of time has been very deceiving in regards to what some of the illustrations have been showing. There's been lots of laws that have been passed that changed from AG 49B to AG 49A that have required these insurance companies to change how they show numbers specifically on these illustrations. And so because of that, these now insurance companies are trying to become a little bit more creative to say, okay, we'll design it with more early cash value, make it look more like a properly designed whole life insurance contract. But if that's the case, well, why wouldn't we just put it in a whole life knowing that there's more safety and guarantees within that? And again, I'm not coming and saying directly that whole life is 100% better than an IUL, because there are some cases where an IUL could be better when it's designed properly with the right company, but it is very rare and in between. And I wanted to just also share with you, I have 3 tabs up here that is going to share 3 things in the marketplace from other advisors on what they're sharing. And so like this first one here was a comment that I did a video, and I shared essentially the concept that IUL is not inherently good or bad, just as long as it's used right. And this agent is, a very well-respected individual in the space. And he essentially said he agrees. He said, but the problem is that majority of what he sees is that there are not very many contracts that are designed well, and that they need to be better shared from an education perspective. And overall, that if we can really share the light on what is going on behind the scenes, that the consumer will be better off. So I asked him the question, I said, okay, like what are you seeing that is not so good in the space? And he said, well, 9 out of 10 IULs that I see are not max funded or reviewed annually. So now that we're comparing it to a S&P 500, essentially how it's performing, you do not have to monitor it every single year on how well it performs, because there is some changes and levers that may have to be used or changed if you want this to be getting the returns and to perform the way that a client would like it to be performed. So there's a lot less back work as well with the whole life than there is in IUL. When it comes to these contracts, they're showing a 6 to 7% return on the conservative side. And this is where a lot of these insurance companies were becoming really mischievous and were not telling the whole truth. They were becoming a huge illustration war, where they were showing that these illustrations had these massive numbers, and then 10 years later, the numbers were drastically different. And so insurance is really supposed to be for risk management, for having money into the future and knowing kind of an idea of what that dollar amount should look like. And when you have millions and millions of dollars that are less than essentially what it was that it was supposed to be, that's a big issue, right? Because you're planning to have a lot of that money there. And when that's not the case, well, then you're obviously at a disadvantage when it comes to your financial portfolio. And the last thing he said is that there's going to be a lot of people that are in this space where their IULs are going to lapse, and that they do not aware of what essentially there is that they're getting into. So then it comes me to this other guy. His name here is Elon Moes. He calls himself essentially the whistleblower of whole life insurance specialist, because he's trying to call out the index universal life insurance space. He even has a book they call it Lapsed Universal Life Insurance Whistleblower. He's like extremely passionate. He's sharing essentially what the regulators are not sharing, the mess that has essentially been ignored, and the big issue that's essentially coming into the space that a lot of people are not aware of. So you can already see that there's a lot of misconceptions that I'm just kind of sharing with you that people aren't fully aware of. And I think the unfortunate part is that there's going to be a time that comes where there's going to be a certain group of people that their policies are going to lapse, and that they got sold a bag of goods that wasn't what they thought it was going to be at the end of the day. Again, I'm not saying that these IULs are bad and who your colleague got set up with. It could be a good company. It could be designed right. And the agent could have lowered expectations, but having all those check marks, I think is very far and in between. And I have never really seen an agent do that, because if they do that, then it's really hard to sell. They're selling it just based off of how it works and how it performs. And so with that being said, come back to some of the questions. It says I can choose what market to use and choose S&P. That is correct. There has been some studies that shown that these insurance companies are creating these indices, these indexes that are watered down, that on paper they're showing better than they actually are, even though they're not going to perform the same way. And the only way to really make this perform even remotely what is showing on paper is by using the S&P, because it's strictly just the S&P, and it's not like half-baked cash, half-baked other assets and bonds, whatever the case is. And so there's a guy named Bobby Samuelson. He's an incredible person. We did an interview with him, an hour-long interview on the Better Wealth channel that I would highly encourage you to watch, because he talks about IULs and whole life when we interviewed him. And so I think that would be another very powerful educational piece for you to 2X and watch, because in there, he is the smartest person I've ever met when it comes to this space. And he's really shares a lot of what I'm sharing, is that it's not necessarily inherently good or bad. It just does what it does. But the bad part about IULs is they're overpromising something that they're not actually going to deliver on, which comes to the point of downside protection / floor of 0, no losses in down years. And so even though the contract is designed to have a floor of 0 with some upside, that is not necessarily true that there will be no losses in down years, because what ends up happening is, let's say the floor is 0, okay? In this contract, you still have fees, you still have cost of insurance, and cost of insurance is extremely expensive on an index universal life, especially when it comes to like some of the later years, because the older you get, the more expensive it costs. And it has like this curve where it starts here and then eventually shoots up. So there could be a little bit more risks inherently, especially if it's not designed properly and at specific times. Now, let's look at a year of like 2008. You start a policy 2008, you have some of the fees, you have the insurance costs, and then there's a down year. So you actually get 0 the very first year, and you actually lost even more money. So that as an inherently false circumstance to saying that there's downside protection is 0 and there's no losses in the down years, because you still can lose money because of the cost, the insurance, the fees. But it's not going to like tank 50% and like go with the market. If the market loses 30%, it's not going to lose 30% because that floor is kind of there, minus obviously the fees and the cost of insurance, etc. So he said upside ceiling, I think it's 12, but I have to check the flexibility. Again, every company's different. The caps are changing. I think something like 12% is where things get a little aggressive, and that'll change over time. I haven't dove deep into like some of the IUL cap rates today because we do write 99% of the time whole life contracts. And so it's just not essentially my necessary field of expertise compared to whole life, because there's really hard to be experts in both. And I share that because you really have to have specific companies that write with IULs and to know their ins and outs. So we write with 5 to 7 companies already with whole life. What we'd have to do is bring in another 3 to 5 companies with IUL to really understand it. So now when you're looking at 10 companies to try to be experts in, it becomes super challenging at the end of the day. And so I know just enough to understand how these concepts and these products work, but I don't know enough to go into the minutia of every single company and contract. But I do know that 12% is extremely aggressive in regards to like some of the upside caps. All right, so I can stop contributing anytime and not committed to a certain number of years like whole life. This is correct to an extent. So what I mean by that is, in a whole life contract, you really can stop funding your contract at a specific year as well. Usually it's right around 7 years. You can stop making all payments if you want. And with the way that we design it, there's lots of flexibility to where you have a minimum amount, a very small amount to contribute that you have to contribute, up to the overfunded amount that you can contribute a ton over. And so in your scenario, your bottom amount I think was close to like 15 to 20K or something. I need to double check. And then your ceiling was $100,000. So you essentially could use cash value to fund that minimum amount, Or you could just fund that a minimum amount for 7 years and you could reduce, pay it up, and you can no longer pay any more premiums ever again if you in theory wanted to. Now, we have it designed to pay it for longer than that because the more money we put into this, the more powerful it is. So with an IUL, in theory, you could fund it $0 if you wanted to in any given year. If you fund it for zero for too many years, this is where things get dangerous. This is why exactly the issue, in my opinion, with IULs is you can stop contributing at any point in time. If you stop contributing to an IUL, early on, the policy can lapse, just like, people are talking about with Elon Musk, the whistleblower. And so it becomes dangerous if you have too much flexibility into these contracts. I personally had an IUL probably like 8 years ago, and that's essentially what happened with myself. Is I got into a contract, I paid it the first year, and then got into some issues and was like, okay, like I'm just gonna wait. And then what ended up happening was because I didn't fund it the second year, I didn't fund it the third year, and then it funded the fourth year. And by then I was like, okay, I don't even believe in this whole IUL thing at that point in time. And I wasn't as fully educated on either direction, is it good or bad? And I was like, I'm just not going to keep this. The policy lapsed. And that happens a lot of times is people just financially get into a situation where it gets into them a problem and they feel the permission that they don't have to fund, which policies can lapse in that scenario. And so with that being said, the whole life contract really won't lapse as long as you continue to make that bare minimum payment, because there's guarantees contractually to go into it. That overfunded piece just allows us to continue to actually have our cash be expedited to grow and to absolutely crush. So again, as long as the IUL is being max funded, overfunded, whatever we want to call it, it's really max funded, designed properly, and the funding is actually happening, there becomes less risk. Because what ends up happening in an IUL, if you think about it, you have some of these fees that in 98% of the contracts are higher. You have less cash value up front. You could have 0 years. There's cost of insurance. And if you borrow against your policy, you now have a loan that's going against it. And now you're no longer making your premium payment. This is where policies lapse and things get extremely dangerous for people, right? So if you have an investment that goes south, if you go south, well, this is where a problem can come in, right? Because you obviously don't have cash flow and funds to pay off the policy loan, make your policy premium payments, and you essentially lost all of the funds that you put into it, from the fees, expenses, commissions to the agent, et cetera, within that side. So you can kind of even see like why I'm even talking through some of this stuff is that some of this stuff is like half truths. They're not fully completely truths. And I think that's where also the industry, I think, has failed as a whole, is that we're not sharing the full truth within how some of this stuff works. Okay, so let's see where we're at here. I think we only have like 3 or 4 more. I can borrow against cash value, protect from creditors overall. Yep, you can do that in whole life and IUL. Amazing. I hope to have 2 to 4% higher returns than whole life based on historical returns of the market and floor and ceiling. Again, it's a hope. I think that the contracts are showing more inflated numbers than actually happening. What I would always say for people from a expectation perspective, we can say that in whole life, long term, you can expect close to a 4% internal rate of return on these contracts. Okay. And if we're best case scenario, maybe 5% on an index universal life contract would be a number that would make sense. So when we say 2 to 4% return higher, when they're both designed properly, this essentially is another half-baked truth. And especially it comes down to like, what year are you talking about? Because in 98% of the contracts I've seen, there's more cash value in the first year, actually like 6-7 years sometimes. And so therefore, if you're saying I'm getting 2 to 4% higher, well, you may say that you're getting 1% higher long-term if both are designed right and with the right company at the end of the day. And again, Bobby talks about a lot of this and says that realistically, these companies should put in a rule where they're mimicking more of a UL, which is universal life that's not going off of the index, because that is more realistic on how they really do perform a lot of the times. Okay, so, and this is coming from just really smart people that have done the research, like really in-depth research, and not just people that have like learned from somebody else in this space. I'm obviously saying it from people that I've learned in this space too, but people that are like experts on this stuff. So my words are coming from really incredibly smart people, and probably not even doing them justice on how much they know. One quick plug here, this video here, it's the last video. The title of it is The Only Video You'll Ever Need on IUL. And so this video here actually gives incredible insight on how IULs actually work, from a cap rate, par rate, so you can see in the background, cost of insurance, spread. So you can see there's all of these different factors and levers that can be moved that these contracts can change, which creates more risk. And again, if we're looking at insurance at a safe place to guarantee our money, why are we putting an extra risk into it as an entrepreneur? If you're somebody who like wants to invest money, like actually I'm gonna use the invest word because when we put it in whole life, it's not an investment. You want to invest money, an index universal life could actually be a good option, but a good option for people that don't believe in the market because they don't want to put their money in the market. They want to essentially have those losses minimized. They still want a death benefit and want to use that for future retirement income in the future. But when you start borrowing and using this arbitrage for index universal life, it becomes super dangerous with all of these different levers that can move up and down with the loans that come into this at the end of the day when you're borrowing for like how you're planning to use it and how often that you plan to use it. So I think that this is another great concept or video for you to watch. And then from the questions perspective, we'll just go back down to them again. I'm aware of 2 financial advisors who choose this for themselves. Amazing. I know hundreds of advisors that choose whole life. And I also know plenty of advisors that choose IUL. IUL has been around, I think, since like the 80s. Whole life has been around for hundreds of years. One has been time tested. One has had lots of problems, lawsuits, people coming after them because millions and millions of dollars have been lost in regards to some of these IUL policies over time. And these insurance regulators have had to come in and step in to fix the issues. And I do believe personally that the IUL space is getting better because the laws are essentially changing and there's been too many issues that have came about. And if a company wants to keep this product around, they have to continue to improve and innovate. So over the last 34 years, there's been a lot of innovation, but that's not essentially tested. And we're looking at where people like banks and corporations storing a lot of these capital. It's not an index universal life, right? These people over time, these banks are storing billions of dollars into whole life insurance because they understand the safety, the guarantees, it being a tier 1 asset. If you even try to get a line of credit from third-party lending a lot of time, this has changed quite a bit, but even like 3 or 4 years ago, you could only borrow like 50% of your index universal life cash value because they understood the inherent risks, versus your whole life, you could borrow up to 95% when you're using a third-party line of credit. Again, I know it sounds like I'm kind of trashing the IUL, but again, this is more so me because this side is saying the good side about it. So I feel like from a justification perspective, this is sharing the good, quote unquote, on this screen. So I'm doing my best to share like the other side of the full truth. Again, I am actually probably the most agnostic in the middle of the pack person when it comes to this product. I just also want to be as completely open and transparent about like what are both sides actually presenting itself. Okay, it has some type of long-term care benefit. Amazing. Whole life has it as well. Accelerated benefits where you could use your death benefit in regards to if you get sick, cancer, those types of things. So a lot of them have the same thing. At year 20 or 30, my guaranteed cash value is approximately 30% larger. Of course, this is exactly what it's going to show. It says my guaranteed cash value. I'd be very interested to see what he's referring to from a guaranteed side, because a lot of times when you look at the guaranteed columns in some of these IULs, there's actually lapses and there's 0. That's what I've seen from 98%. And again, these companies could be very innovative and be changing things. But if you're now looking at guarantees in a contract, why wouldn't you just work with a whole life contract and use that instead, and knowing that it's safer, less risk, less movers, essentially knowing what's likely going to happen in the future, versus in the IUL, you're not 100% exactly positive that this is going to perform the way that it says it's going to perform. So that's what I just wanted to share with you is I personally, as somebody who had this conversation with you about your insurance contract, 100% believe that the whole life is 100% better for you in your situation. I believe that an IUL would have been a disservice for what it is that you were trying to accomplish. I'm not 100% sure on what it is that your friend or your colleague was trying to do, or what he's trying to get into, or what it is that may be best used for him and his situation. But I believe what I believe in, and I stand by it. I hope this helps. Feel free to watch some of the education that I shared with you in regards to that video, the only video you'll ever need. There's lots of people on the internet that are fighting both sides of the coin, that share whole life is the greatest thing of all time and IUL sucks, and that IUL is the greatest thing of all time and whole life sucks. It's kind of like this battle that has always been constantly. And I don't think that there's ever going to be a world where this stops, because I have seen people trash whole life just like this Elon Moes guy trashes IUL. So if you just spend any time on the internet looking, you essentially can find both sides of the coin, and I think it becomes very confusing to the consumer. But just know, like, what you got set up with was an incredibly well-designed, high early cash value with lots of guarantees that's going to perform extremely well for you and your family, that you'll be proud of in time to come. So just wanted to share that. I would love for people that understand this concept to share your insight below on what you think about whole life versus IUL. Which one's better? Did I answer this well? How could I improve? What is your insight? The collaboration is real here. I'm always looking to improve and get better. I love when you guys respond in the comments so we can co-collaborate. I always respond. I'm there to have that conversation. With that being said, thanks for watching. Please subscribe. Talk to you soon.